Welcome to the Daily Brief, where I'll go over the highlights for the action in the market for Tuesday, December 27th, and then we'll see how things look for Wednesday, December 28th. We had a mixed day. The Dow was up a little bit. The NASDAQ was down pretty well over 1%, almost 1.5%, that and the NASDAQ 100. And the S&P, which is kind of in the middle, it was down slightly. Our technicals are still negative overall, but there's this hope in the background that maybe there will be some kind of a Santa Claus rally that will happen from now until the first couple of trading days in 2022. Before I get started, I want to point out to you a free webinar that's available. It's called Market Vision 2023, and this will be happening on Saturday, January 7th. It's free. I have no connection with this company at all, but there are some videos that I watch and some people that I kind of pay attention to that will be putting on this event, and some of you might find this helpful. There's a screenshot here where all you have to do is provide your name and email address, and then you join this event. You'll get a confirmation email. I've already signed up personally, but if this is something that interests you, you might want to take advantage of this, and I'll put a link to this event in the description below the video. All right, let's talk about what happened on Tuesday. Right at the open, we had a lower open down below the daily pivot at 38.29. We almost made it down to S1 at 30.18, just a tick or so above S1, before we saw prices rebound back up to the unchanged level, which this is interesting. We had a down day, prices were going back up. It hit that unchanged level, and that acted as resistance. It actually hit that level a couple of times in Tuesday's session. When we're having an up day and we fall back, sometimes the unchanged level will act as support. It's kind of a built-in support resistance level. As the day went on, prices pretty much chopped sideways. They remained positive. We briefly fell below the daily pivot before going back up and then closing pretty much at the daily pivot. We were down 0.4%, and volume is still below average because everybody is in holiday mode right now, and that will probably last for this week and even going into next week. Our technicals, as I stated, are still negative overall. Got the markets really fixated on this inflation and interest rate scenario that is producing growth concerns, not only economically, not only maybe for you personally, but for stocks in the US. And we're also seeing this happening globally at the same time. Here is the chart showing that we were down at the open, dropping quickly below the daily pivot. We went down almost to S1 before rebounding up to the unchanged level, drifted sideways, tried to get back above the unchanged level. That was not successful, and just drifted a little bit lower below the daily pivot before staging a late day kind of rebound, but then seeing some weakness going into the close, and we were right about at the daily pivot. One thing I want to point out that I don't usually mention in the videos, but I'm going to start doing that. Every day I update two charts. There's the daily chart, which just shows the pivot levels for that particular day. So this video is being prepared for Wednesday, so these will be Wednesday's pivot points. Then when I do Thursday's video, there will be pivot points for that. That's an intraday chart that really can be quite useful to some of you to point out support and resistance. I also update another chart that is good for the whole month, and those pivot points don't change until we get to the next month, but I update them with the current prices. So you can find those on the community tab on the YouTube channel if you feel that those will be useful. I rely pretty heavily on those, and I talk about the pivot points a lot in these daily videos, so that might help you as well. All right, so what are some comments that we can make? The Santa Claus period for the rally is the last 5 trading days of the year, which we're in right now, plus the first 2 trading days of the new year. So that still has yet to come. Another thing that was is coming out is that China will end quarantine requirements for international travelers, and this will start on January 8th. Now, I'm hearing even more than that on a firsthand basis from parents and students that I teach English to. They're really lessening a lot of the restrictions. Some schools, they're having where you stay at home and do internet-based school or online school. They're really relaxing a lot of those restrictions. The unfortunate thing is a lot of folks are getting sick because of that, but this is more the Omicron variant, which is not as severe as other earlier versions of the coronavirus. But the market is taking this as more positive. So companies that do business in China or companies that are impacted by what happens in China because of the supply chain, that is being seen as more positive. The VIX is still acting kind of strange, and I'll have a chart to show you there. The concern right now is the earnings per share on each individual company, and then taking indexes as a whole, and then also focusing on the valuation concerns. Are we still expensive? If earnings per share, if the forecasts are going to drop, that may push stock prices lower. If we're going into a deeper recession, or if we're even going into a recession, depending on what method you use to define that, that typically will bite into corporate profits as well and can have some negative impacts on the market going forward. And that's really producing a lot of headwinds right now, because it's ultimately companies have to make money to justify or not justify the price of their stock. And if those earnings are coming down, their stock prices will probably also come down as well. In Tuesday's session, the dollar did decline, which we've been seeing more renewed weakness in the dollar, and interest rates were up. And the Dow was up, but the NASDAQ and the NASDAQ 100 were down almost 1.5%. I think the NASDAQ was down 1.38%. The NASDAQ 100, which this is heavy tech stocks, it was down 1.48%, something like that, but not quite 1.5%. But that was really what took things lower, was tech. And on a short-term basis, we still have some of our PMO studies that are looking kind of extreme negative. The Stochh RSI and the Williams percent are, I have the PMO studies chart to show you. I don't have the Stochh RSI and Williams percent are. They're just barely into extreme negative territory. So that means they could still have more room to fall from there. So we're just barely into this oversold condition. That doesn't mean we're going to stop, but it means that we might slow down. But we've been really chopping around for the last number of days, and so that may continue. And our ADX is pointing that out as well. We still have all of our yield curves that are inverted, that have been inverted for quite some time. Sentiment is still fearful. It's not extreme, so we tend to go with that. So that points us more on a sentiment gauge at the fear side of things. And when I did the video for Tuesday's session, I said that there were no economic reports. The calendar that I usually look at, it was blank. Well, apparently it hadn't been updated, so that's why I said there were no reports. We did end up having some economic reports. The advanced report for international trading goods, it was a negative 83.35 billion, which was less than the 98.8 billion last time. And the advanced report for retail sales, it came in at 0.1%. The last time it was down 0.4%. And wholesale inventories were up 1%, where the last time we had this report, it was up 0.6%. The FA housing price index, it was unchanged in and of itself, which is, we're seeing a lot of weakness in the housing market right now. So the fact that it came in at 0.1%, which is what we had last time, that can be seen as somewhat positive, but still we're not seeing any growth from that. And the S&P Case-Shiller Home Price Index, it came in at 8.6%, which was more than the 8% that they expected, but less than what we had last time at 10.4%. Our trend is still negative overall. The red line's on top. It is weakening. The ADX is trying to get above that moving average, but it's just a little bit below it right now. Overall, the ADX is still below 20. our bias, I've switched over to mixed right now because we're just chopping and not really going anywhere up to this point. We'll have to see if that changes going forward. And our momentum is still mixed. Here's the chart. I don't have an updated version of this chart. It's not really all that necessary because we can follow the white line. That's the S&P 500. That's what's happening now. The green line is what happened from 2006 through 2008. And if we follow along with what happened during that time, we could see some weakness going forward from here, especially into the end of the year. Also, the VIX, which has been pretty tame right now, it's still in the lower 20s. But if we do really start to fall, you would expect the VIX to really pick up, and it's just not happening yet. Here is the VIX showing that the ratio between the VIX and the S&P 500, it's really showing more of a correlation between the two, and this continues to go higher. And where I have these red lines, when we hit an extreme reading, a lot of times that ended up marking some kind of a short-term to intermediate-term decline or top in the market. Not all the time, but a lot of the time, that's what happened is the S&P would go up and then stop and then decline after that. So we'll just keep watching this. We're not really at an extreme reading, even though this has been going up over time. We will really pay attention to this if we get up to these really high spike levels and then start to come down. The Ulcer Index is also suggesting that fear is increasing slightly. We're above the moving average. That's the neutral point, and we've climbed back above that. So there's a lot of fear, but it's not necessarily extreme at this point. The equity put call ratio, after really spiking up on that one-day reading last week, really fell, and it increased slightly with the down day. Here is our 5-period simple moving average. Again, after creating this big spike, it came down a little bit, and we're pretty much flat to slightly increasing. Again, here's a longer-term look at that chart. Where I have it highlighted, that's the current reading, and we haven't seen a reading this high in a long time. The unfortunate thing about this, or the thing that makes us kind of suspicious of this reading, is we typically hit this when the market has been going down and it hits some kind of critical mass to the downside and bottoms and then starts to go up. Well, we've been chopping sideways as this equity put call ratio has been going up. So it's not really characteristic of how the market usually behaves when we really pay attention to this signal. But we'll keep watching it and see what happens going forward. Here's the ADX, where we're just a little bit below the moving average. It's pretty much going flat to trying to turn up, but the red line is on top, even though it's declining. So we default to a negative trend. But since we're below 20, it just suggests that we pretty much, as this has been suggesting, that we have been chopping sideways, and that's what we've been seeing lately. Here's the BPI, which actually ticked up slightly. When we had the upward movement of the S&P 500, it picked some of that up. But overall, we're watching this, what you could say is a topping pattern. And again, a lot of times when we get a real top in the BPI, we see some kind of a spike in the S&P like we've seen before. Well, that really didn't happen this time. So again, we're just watching this to see if these things that we're seeing from our indicators do in fact turn valid. Here's the PMO studies, where the PMOs that are rising, it's no longer extreme negative. The buy signals, the number of stocks in the S&P 500 that are generating PMO buy signals, that is still extreme negative. The PMOs that are above zero continues to decline. Here's our stochastics. We're just barely getting into this extreme reading with the short term. We're turning back down slightly with the intermediate term, and we're starting to come into an extreme negative reading with the longer term. Please be reminded that these are subdivisions of the short-term time frame. Here's our daily chart, where we're still above this pivot points, and we're not very much, but we're still above it, so that is positive. Can we bounce up off of that and maybe regain the 50-period moving average, or will we fall down below that and see more continued weakness? And then down at the bottom, you see where volume did pick up from Friday's session, but it's still well below average. Here's our moving average tree. We're underneath all of the moving averages that are plotted here. If we do start to go up, they may act as resistance going higher, but since we're below all of these, they won't necessarily provide support because there's nothing under us to provide support. The new highs, new lows, we saw a little bit of a breakout with the new highs and a contraction of the new lows. So this is starting to turn back up, but it is still negative overall with our 5 period, and we're still flat to declining with our 10 period. The Elder Impulse system, it gave us a neutral reading after Friday. Well, it continues to give that neutral reading after Tuesday's session. The STO still is looking a little bit more positive. It's advancing based on price and volume, and based on price, we've climbed above zero. That's when it turns more positive. We haven't really got there yet with the volume, but it is going up. The support is holding on the Ichimoku cloud. We're getting into this green area and seeing if can we see a bounce out of this, or will we end up breaking down below that. Here's our short-term fib level going back from the August high to the October low, and it also measures the September high to the October low. And we have a double fib level right here, which is just about where prices are at, a little bit above this. So for right now, this support level continues to hold. Longer term, we're right about on this double fib retracement here, maybe a little bit below it. The thickness of the lines and the fact that I draw these freehand, you may get slightly different results, but we're right about on these lines currently. The weekly chart, we're right about on this 38.2% retracement. We're still above the 200-week moving average. So for right now, after Tuesday's session, support is still holding. Can that continue, or will we fall down? If we do start to go lower, we're going to really be watching this 200-week moving average. That's very long-term, and it held back in October. If we come down to this level, will it hold if we test that level again? We're still at the underside of our trend channel, which is just about in the midpoint currently. And the staple sector, I brought this up after Friday's session where we just had a golden cross. Staples are the things that people get no matter what's going on in the economy. And the stocks that make up the staple sector, they tend to be more defensive. These go up when the market is going down, because these stocks may perform better or go down less than a lot of the growth stocks that we follow. The Dow is still above both of the moving averages. We had a recent golden cross, and we're still above this. You can see the Dow was actually up 0.11% in Tuesday's session. So far, this seems to be holding up. Can that continue? And then silver, I wanted to bring this up. Gold is not really all that close, but silver has just given us a golden cross. And so it's starting to see more of an uptrend. But there have been other times when we've had this cross and it's just chopped sideways and then broke down. And that's one of the things with the precious metals is it's really hard to find a trend, especially in 2022, where this looks like a trend, but look at all the gaps in this chart. It makes it hard to have any confidence in the trend at times. So what's our outlook for Wednesday? The technicals are still negative, but we keep asking this question: will the Santa Claus rally happen? And the economic reports that are coming out on Wednesday, the weekly MBA mortgage applications index, and the pending home sales. We're getting more home information. All of the geopolitical events, with the real fixation being inflation and interest rates, but you have a lot of folks that they might be keeping an eye on things, but they're into holiday mode now, and that's why volume has really dropped off. They're distracted more or less with wanting to spend time with their friends and family. So we have to watch that, because when we have lower volume days, something could happen. It could really gyrate the markets. So far, that didn't happen in Tuesday's session. So our scenarios, not really going with the down scenario. We're becoming a little bit potential for becoming short-term oversold. We're just barely into that territory. And so we don't really want to go with this because we've been chopping sideways. We're in a trendless environment right now. We can't go with the up scenario because all of our charts are still pointing down. And we ask the question, can the rally that the market is hoping for, can that happen? Our scenarios, our rotation, our setups, they're still showing weakness. They're still breaking down, specifically the sector rotation. And the technicals are still negative overall, so we can't really go with the up scenario. We're below the moving averages. We're holding up okay with the pivots. Fib retracements, those are holding up for right now. But if we start to go higher, some of these levels may act as resistance. So we're going with the sideways trend where the ADX is still weakening. It's below 20 and is negative. So what's our conclusion? The S&P is negative overall. No matter what they say about this Santa Claus rally, we still have to look at our charts. In the short term, it's negative, and again, slightly getting to the point where it could be oversold. Intermediate term, we're just flat out negative. There's nothing extreme negative of the charts that I follow in the intermediate term. Long term, we're still negative because we remain camped below the 200-day simple moving average. Thank you. Have a wonderful day on Wednesday. If you want to sign up for that free webinar on the 7th, please feel free to do so. I've already signed up and will be attending. Have a really good day, and I will talk to you in the next video.